what's very apparent today is that you guys are on all different levels of investing, right? A lot of you guys are what I call level ones. You're just beginning. You're trying to get your first deal, like Mark was talking about. Some of you guys have done a couple of flips. Some of you guys own some rentals. So you guys probably be more like level threes because we go from level 1 to level 5, certified pros. And so for me, it helps. So what do you? How many of you guys? It's a two-question. I have two answers. How many of you guys think it's harder to find the money versus harder to find the assets? So raise your hands if you think it's harder to find the money. Wow. Raise your hands if you think it's harder to find the assets. Oh, okay. Right. That's about right. Finding the assets is the hardest part. Once you found the asset, the money is the easiest part. So I'm going to talk a little bit about how we do that, how we get the money, but I'm going to talk about a lot of different topics. A little bit about me, 25 years in real estate, licensed realtor in Virginia. I own a brokerage in Maryland, D.C., and Virginia, but I'm not licensed in Maryland or D.C., go figure, but I do own a brokerage there. I own a couple of companies, Clear Sky Properties, Clear Sky Financial, Clear Sky Holdings, which I'll talk about a little bit more on the next chart. We've developed a car wash before. Car wash went to eminent domain, which is why Ed Grass, my partner, is here. He helped us get through the eminent domain process with the state of Virginia, city of Chesapeake. Won us a pretty good-sized lawsuit. I co-owned a title company. I've got some philanthropic things that I like to do. I'm president of a low-income housing charity called Catholics for Housing. We're nothing in the low-income housing space. My claim to fame is I helped them purchase a dilapidated trailer park in Manassas that we got cash flowing. The city of Manassas was going to kick out 50 families because there were sewage problems, water problems with the water pipes, and they're going to kick them out. We came in, saved the day, purchased the trailer park. Also an expert witness. My latest philanthropic activity is going to be Clear Sky Sports Angels. We're starting to donate money to disadvantaged kids to allow them to play travel sports and sort of equaling the playing field from a socioeconomic injustice. Oh, I'm sorry. How do I go back? Can I go back? Uh-oh. Where the hell is that? Here? Ah, it works. Okay. Clear Sky Group. We have a 4-pronged business model. We're obviously hard money lenders. We have quite a bit of money out there on the hard money side. We've probably got between $36 and $38 million out there on the street. We lend in D.C., Maryland, and Virginia. Prong number 1. Prong number 2 is we have a really good size rental portfolio of properties and commercial properties. So we manage our own properties. One of the commercial properties being a truck yard. We've done some development ourselves. The third prong is we still fix and flip houses. We flipped over 400 houses. We've done a lot. So there's not an asset that we haven't seen that we don't know anything about. D.C., Maryland, and Virginia. And the fourth prong of our business model is we're tax lien certificate investors. Okay? So we are all across the gamut, anything and everything real estate. We're either doing it or we've done it. So that's pretty much who we are. So what I'm going to assume tonight when we're talking about money is that you guys are going to need money for a bunch of things, right? You're going to need money for fix and flips. If you're a wholesaler and you want to hide your wholesale assignment fee, you guys know what wholesaling is, I'm assuming? We will do what's called a one-day transactional fund, and you'll do a double close. And the reason why that's important is because certain wholesalers are making a lot of money on their contract assignments, so they might want us to come in there and save the assignment fee, because if the seller finds out about the assignment fee on the HUD-1, they might pull out of the deal because they're like, why are you making so much money and I'm not? So that's another thing that we do. We do financing for buy and holds. If you're buying a house, you guys are familiar with the BRRRR method? You're buying a house, you use us to buy it, you want to renovate it, rent it out. That's why you would use us, because normal lenders might not lend on the house if it needs a lot of renovation, and then you refinance us out. So we do buy and hold lending, we do lending on condo conversions, we do bridge loans, and then we do cross-collateralization lending. Okay. Here's what we've developed and created. This is called the roadway to wealth in residential real estate investing. Okay? So what we've done is we've created a roadmap. You know nothing, you have no money. We're going to take you through the process to get you into generating what's called residual income. And so we go along the roadmap, and today we're right here. We're finding the money. We're going to teach you how to find the money. Part of us is lead generation, finding the distressed assets. But on our roadmap, we're right here. So what we do, we educate folks through lead generation, through finding the money. We also have a financial literacy class. We have a fundamentals in real estate class. And then we have some residual income classes. We're going to teach you how to wholesaler flip, because flipping and wholesaling, what you're doing is you're building your capital stack, right? So you've got to learn how to build your capital stack. Why do you need to learn how to build your capital stack? Because you're going to take that capital stack and then you're going to put it into residual income streams, passive income streams. And I've already talked about a couple of the passive income streams. What are they? Maybe you want to be a hard money lender yourself. Maybe you want to build your rental portfolio to create some residual income. Maybe you want to build a commercial loan portfolio. Maybe you want to do tax lien certificate investing. Maybe you want to do multifamily investing where you're maybe part of a syndication. Maybe you want to invest in a real estate investment trust. So what we're doing is we're taking you across this pathway and this roadmap, and eventually we want to help you create the residual income so that it matches your current spending footprint. Voila, then you're financially free. All right, so that's one of the things that we do as well. Oops, got to go back. I'm hitting it too hard. Getting the money. What does Bob Hope say? You guys are going to laugh at this. A bank is a place that will lend you the money if you can prove that you don't need it, right? For us, we're at the point in time where, and I'm going to talk about soft money later, where these commercial lenders, these commercial loan officers jump from bank to bank to bank to bank. So at the very beginning when we needed money, we were thumbing through these things called the yellow pages. But today these guys are moving from job to job to job. Banks are actually calling us and asking us if we want to establish lines of credit with them. We don't really need it, but they're calling us. So that's kind of why that quote kind of rings true. Okay, current economic environment. You guys have to understand where we are, and I think most of you do. We're in a high inflationary environment. The government's recently got it under control. Rising interest rates. The Fed has raised the rates 4 times for 0.75%. They've raised it 2 times, a half a point, and they've raised it 5 times, a quarter of a point. What has that done? That has doubled the 30-year interest rate from what it used to be about a year and a half ago. That has doubled some people's payments, right? That's something to keep an eye on. And that's gonna lead to a couple topics in my presentation that you guys are gonna want to learn these concepts. Housing sales have slowed in some markets. You guys are like, no, they haven't. We're in Northern Virginia. There's no inventory. I'm having multiple contracts on my listings. That's true. Not in Maryland, not in D.C. There's a lot of markets out there that have high inventory, and the prices are coming down. So it's very subdivision specific. So you've got to know where you are. Office space availability. Why am I bringing this up? Because the Class C, Class B office space crisis that we're about ready to run into, where the office buildings are valued way too high, the net operating income on these rents is going down because of vacancies and because of companies consolidating the leases and because the leases are getting lower in price. What does that do? The valuations of these buildings are coming down. Why do we care? Well, we care because commercial banks are the ones lending to the owners of these buildings. The valuations have got to compress, which means these banks have got to raise more capital to stay solvent. Silicon Valley Bank, different issue. So what we're going to end up seeing is we're going to see a mini small bank crisis. But that's opportunities for us because the FDIC is probably going to gobble up some of these banks. Low residential inventory. And I've got number of foreclosure filings way up. That is true in Maryland and D.C. Virginia, they're about the same as in a normal marketplace, but the number of houses coming to the foreclosure block is low. Okay, so we've got to keep an eye on these market indicators. Now, money sources that I'm going to cover. Now, what I want you guys to do, when I'm done with each particular topic, feel free to ask questions. So I'm going to talk about hard money, soft money, subject to, we're doing a subject to deal tomorrow, talk about that, owner financing, but I put in another subject matter on owner financing called shared appreciation mortgages. That's very important for you guys in the fix and flip space, so we're going to cover that. DSCR loans, traditional mortgages, but I'm not really going to cover much on traditional mortgages because you guys know what it is, I'm going to cover the assumability on it, the FHA and the VAs, because you guys got to know that. I'll cover HELOCs and cash. There's a reason why I'm covering HELOCs and cash, because especially on the cash piece, I'm going to show you guys how you need to calculate your liquidity if we get there. Now, I know you guys have heard talks on certain of these ones. I can skip over it if you want me to, or I'll cover it because, huh?
I would almost say the opposite and just like slow down on them. I think people really want to
Yeah.
keep on these topics.
I'll slow down. I hope you guys have all night.
Waiting for the right opportunity.
I have all night. Trust me. Hard money. What is it? It's just like your used car salesman. What's the first thing you think about a used car salesman, right? It's not a very good mnemonic. Well, hard money lending is sort of the same thing. You think of hard money, what do you think about? High interest rates, high points, blah, 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 right? Well, loan shark, right? Right? I've been called that before too. Loan sharking. The reason why it's called hard money isn't because it's hard to get. It's just the opposite. It's probably the easiest kind of financing you guys can get. It's where the asset stands up on itself. So the loan is based on the hard asset. If somebody is checking your credit, checking your income, doing all the normal paperwork things that a lender needs to do, they're not a hard money lender. They're more likely a loan broker, and they're trying to check all the boxes and sell off the loan. But really what a hard money lender is, it's straight asset-based lending. And it's straight lending on the after repair value. Okay, that's the fixed up value. That's the max value of that asset. So they're lending on multiples of that. It has no bearing on what you're buying it for. Okay, so keep that in mind. It's a short-term loan. Ask me how many applications one of my borrowers have filled out, and then ask me how many credit checks I've ever done. Right, 0. Okay, we don't even have an application process. We just don't need it. Now, I do care about credit if you're doing a BRRRR, right? Because you're going to need to refinance me out. Maybe not with a DSCR lender, with somebody else. But even on a DSCR lender, they're going to need to know your credit score. So I'm going to ask you. I'm not going to pull it. I'm just going to say, hey, Patrick, what's your credit score? And he's going to tell me, and I'm going to say, oh, that's good. It's fine. I know you're going to be able to qualify for a DSCR loan. And then you're asking myself, well, you don't know. You didn't pull his credit. You're trusting him, right? Well, why am I going to trust him? Because guess what? Patrick is already trying to become one of my borrowers. If Patrick told me that he has a 710 credit score, he buys a buy and hold through me. I do the buy part, I do the renovation part, he gets a renter in there, and then guess what? 9 months down the road, he calls me and says, hey, I didn't qualify for that DSCR loan. My credit score is only 600. Do you think I'm going to lend to Patrick again? No. We have a character problem. Okay? So just be honest with me. Most people are. No tax returns and fewer, if any, income restrictions on hard money loans. Hard money loan types. What are they? We talked about this a little bit earlier. Fix and flip loans, fix, flip, and renovate loans, buy and hold loans, bridge gap funding, transactional funding. We talked about that a little bit. LLC purchasing, and then multi-collateral loans. You guys are going to want to know what's an LLC purchase. Here's why you use a hard money lender for that. So one of the things that's going to come up in the next 2 or 3 years, and it's already starting to show up in Maryland, is that houses are going to need to be sold via a short sale. You guys know what a short sale is? We all know what that is? Okay. What happens is an LLC is going to buy a short sale. The bank issues what's called a third-party approval, right? But let's say the short sale buyer got this house at such a great price, right? But the bank has already approved this LLC. So what the person wants to do is they'll actually wholesale their LLC in the form of an LLC purchase. So that's where a hard money lender will come in, is we will fund that LLC purchase. Now it's a single-use entity LLC that's just buying that house. So we're gonna allow that LLC to be purchased. The guy who originally went under contract with the short sale is going to make their LLC profit, whatever that is, because if you change buyers on a short sale, they have to go through the approval process. So that's what that means.
Are you essentially talking about a wholesaler in that case?
Could be. Yeah. Could be a wholesaler. But they have to own the LLC. They've got to be a managing member of the LLC. So when they file the LLC docs, they are the managing member.
I guess my question is, if I'm buying a house, my goal is to buy the house. And I understand there's going to be chaos and delays in a short sale. But can you give us an example of what you're getting at? Like, what would cause?
The biggest cause, there's two things. The first cause on why they would flip their wholesale is because the wholesale might have taken nine months to a year.
The short sale.
The short sale, sorry. So the short sale might have taken 9 months to a year for the bank to approve it. Markets might have had a 10 or 20% increase, 10% rate. The other thing that might happen is that the renovation is so extensive that maybe they get nervous about it. And they say, I'd rather pull a quick 30 grand out of it than do the whole flip and make 100. That happens quite a bit. So those are usually the scenarios on why somebody would sell their LLC on a short sale. Okay, scenarios for hard money. Why do people want to do it? Because you guys are like, oh, hard money lender, high interest rates, high points, I don't want to use it, blah, 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 right? You need cash. That's usually the biggest one. Most of the people that we lend to are not bankable, and they don't have much money, but they found a good deal. So we're never going to turn down a good deal. We don't care who the borrower is. As a matter of fact, we care, and don't take this personal, we care more about the contractor, Mark, doing the work than we do the borrower. I hate to say it. Because the contractors will get us in trouble if they're not doing work on time and within budget, and hopefully there's not too many COs. Change order, right? So we care about the contractor more. Why else do they use us? The biggest reason why they use us, we close in a week or less. I can close a deal in 24 hours provided that the title binder is ready and the title's been pulled and there is a title binder, okay? Further leveraging of your business, right? You're a flipper, you got all cash, right? You got one deal under contract, getting renovated, you might have found another deal, you've run out of money. Guess what happens when the third deal comes? You're like, oh my gosh, I can't turn this down, even though you're out of money. Oh, I need that hard money lender. I'm going to pay those rates because I got such a great deal on it that I'm going to use them. So that's another reason why further leveraging of your business. But the most important reason why people use hard money is OPM, other people's money. And I've got an example, I think. I don't know if it's part of this chart or not, but I explained to you about the leverage, ROI. So if you're really a smart investor, you're not going to worry about the higher interest rate because hard money lenders provide you with the max leverage on that purchase. 100% sometimes financing, 100% renovation, maybe build in a few months of payments if the deal's that good. How much of your money are you picking out of your pocket? You might pay some taxes, you might pay some utilities, you might pay some HOAs, but at the end of the day, if you're making 50, 60 grand and you're only spending $5,000 out of your pocket, it's an unbelievable rate of return on your money. So that's another reason why they use this, is for the leverage. Hard money versus other lending types. Caveat typically, we do not invest in primary residences. That's kind of not true. I'm doing 3 deals in the next week. Second trust on one house, first trust on another house, someone buying a house in their personal name in Virginia. So we're doing it. The caveat is to avoid TRID and the consumer protection laws. In the state of Virginia, an attorney is allowed to originate a loan to a consumer. The attorney originates it, they assign it to us. We're funding it. So that's how I get around TRID and all these other laws. We do not sell loans. I service everything. We service everything through the mortgage office. We have customized lending criteria. We can close in 24 hours. And we're, like I said, we're an asset-based loan. The asset's got to stand up on its own. Okay? What? Well, what's going on today with realtors is a lot of guys are having a tough time with commissions and doing deals. And so in a lot of cases, these guys have, for example, we're doing a second trust in Fredericksburg or Stafford. The house is worth $875. Realtor who hasn't had much commissions, he's had some other personal life experiences. He only owes $400 grand. He needs a second trust for $75 grand. He's starting to get his business going. So we're giving him a $75,000 second trust. He's got like $50,000 in credit card debt. He's going to wipe out his credit card debt. He's got some commission deals coming up, plus he's doing a couple fix and flips. So he's getting back on his feet. So he'll then refinance us out, take the first and the second, and take us out. So those are some of the reasons why. I mean, you'll be surprised. There's a lot of different reasons.
I mentioned something on the previous slide. You don't need to go back, but I know there's varying levels in the room. When he was talking about servicing, there's 2 things to mention there. One, just the simplicity. You make the payments to the mortgage, whatever the company
The mortgage office, yeah.
But more importantly, Charlie and his team are making all the decisions, right? It's not some end
Right.
investor that's going to naysay.
Right. I'm the one saying yes. So I'm the tip of the sword. So if you bring me a deal and I like it, it's always a yes. But if you bring me a deal and it's a high dollar deal, million plus, 1.5 million plus, then I'll confer Sam. I'll ask him about it, and we'll compare notes, because those bigger deals for us, I mean, like I said, we're what, $36 million out there. $1.8 million deal is 5% of our portfolio. So we're we sort of tread a little bit lightly. What do the borrowers need to know, you guys? You need to know the after repair value. You need to know your project budget, so you need to have a good contractor. I'm going to want to see a contractor budget. I'm going to want to see it all the way down to the draw schedule. And then we have to ensure a profit margin, especially if you're doing a fix and flip. If you're doing a buy and hold, I'm going to want to know the rents. I'm going to want to know how its cash flows, just to make sure that you're getting into a decent investment, okay? What do borrowers need to have? Lender's title insurance. No ifs, ands, or buts. We've had a couple of title insurance claims. So we need title insurance. It's a normal real estate closing. It's a normal deed of trust. It's a normal promissory note. It's a normal real estate transaction. It's just that it happens faster. You need to have hazard liability insurance on the property. We're going to be named as a mortgagee clause in case house burns down. And you have to have an LLC in good standing. I can do owner-occ loans, but I don't like to. I try to avoid it, so we probably have about 90 loans out there. Maybe 5 or 7 are to owner-occs, not very many. Underwriting criteria, first thing I need to do, and that's the first question I'm going to ask any phone call that I get. What is your exit strategy? Is it a fix and flip? Is it a buy and hold? Are you just going to pay me off? Are you building it and you're going to sell it? Are you moving into it? I had a deal in Bay Avenue in Maryland. It's supposed to be a fix and flip. The guy ended up moving into it. And he can't get refinanced. And so now I'm in a little bit of a quandary. He's like, I own this property with my partner 50-50. It's in an LLC, but I moved into it and I can't refinance. And I'm like, dude, just buy your partner out. I might have a loan for you. You might need to help me out on this. Can you do Maryland? You're going to get this deal. So he's a contractor. So my guess is he probably has 1099 income, doesn't have enough 2 years of track record to show for it. Now he's in a quandary. And I'm like, look, this was never supposed to be, you're never supposed to move into it. You need to sell it. And then he goes, well, maybe I can have my dad buy it. I said, that might be a good idea. So, but I had the exit strategy. He was supposed to fix and flip it. But these things happen. Determine the ARV. I'm going to do that. You're going to do that. We're going to compare notes. I want to make sure we're on the same playing field. If your ARV is long, I'm going to tell you. We'll loan up to 75% of the ARV. I've got a deal going out in Manassas on Rob Nell, 75%. Most of my competitors are 65% ARV. This is like our separators from everybody. But remember, we're going to be a little bit more expensive. So my separators is I'll go to 75% of the ARV. Up to, keyword. Why? Because age, renovation, asset type, lien position, and marketplace are determining factors. If I do that same property in Petworth, it needs a $200,000 renovation. By the way, Petworth is a subdivision in D.C., row homes, built 1910s, 1920s. 3 levels, sometimes they need to be, the basements need to be dug down a foot. Renovations are anywhere from 180 to 210. If I'm lending on a single family house in Petworth, a row home, that 75% of ARV turns into 65%. My parameters change. Loan to cost, right? What does loan to cost mean? It's your purchase price plus your renovation. That's your loan to cost. I will lend between 85 to 100% loan to cost. If your deal is a slam dunk deal, I will give you everything. I'll give you 100% purchase. I'll give you 100% renovation. And if I have enough room, and if it's in Northern Virginia and I know that market's flying and I go to 75%, I'll give you 3 to 6 months of prepays on there. So you ain't got to do nothing but hire Mark and get that renovation done, put that sign in the front yard, get that flip done, and get me paid back, and then get you your profit money and you be on your way. We'll do that. Remember, the loans have nothing to do with the purchase price. I don't care. I like to do my parameters first, right? And then tell you, I do need to know what you're purchasing it for, and I need to know an estimation of your renovation budget, not exact science. But if you're doing a full gut renovation in DC and you're trying to tell me it's going to be a $75,000 renovation, I'm going to tell you, give me a contractor estimate before I even talk about it, and then we'll deal with it. And then the length of the loan. My normal loans are 6 to 9 months. In DC, I'll go a year, but we have a 3-month extension in place on every loan we do, so that if you, for whatever reason, you run into problems, either refinancing your BRRRR or some problems in your fix and flip, then there's a 3-month extension already built in, so we can save you that way. Okay.
What determines the 85 to 100 LTC?
Oh,
What determines
it's right here.
85 to 100?
Age, renovation, asset type.
The loan to cost?
Yeah, loan to cost, but also for me, it's also the marketplace as well. And it's also your purchase price, and I'll go through an example here in a minute. It's also your purchase price plus the renovation. So for example, let's say we have a Hiltonian in Dale City. Hiltonian is a 5-bedroom, 3-bath house. It's one of those nice, what do you call it, split foyers? They're selling for about $500,000. Let's say, and I know this isn't, you can do this. Let's say you're buying it for $300,000 and the renovation is $70,000, $75,000. So your purchase is $300,000, your renovation is $75,000, $375,000. I know that the value is $500,000. I simply multiply 0.75 times 500, and I know I get more than $375,000. So it all depends on that purchase price and that renovation. So if those criteria meet, then I'll give you the whole thing. So that's what kind of determines it. There's a lot of factors that go into it. That same property in Petworth, you're getting an 85% LTC, and you're getting a 65% ARV. And if the numbers don't fall in there, then you're going to have to come up with more cash to close. Okay, so, and that's why what Tim brought up earlier is that through our algorithms that we make up every day, that we can change every day, that we change on, depends on who the client is, right? We have that ability to say yes to anything we want because it's our money, right? We've got to protect our money, and it's our investor money as well. We do have investors. It's not totally our money, but even though it is.
As long as it's an investment that you don't deem risky, then you will go up to 100%.
Right.
Loan to cost.
Right, right. Because at the end of the day, on the hard money side, even though it's a lender-borrower relationship, it's more than that because you're renting our money. You're renting it. It's a quick fix, right? Ed tells me all the time, I'm like the crack dealer. I'm just giving out crack, right? And so the crack is the money. But we're going to make sure together, because we're a team. Because if you're not going to be successful on whatever deal that I'm lending on, do you think that you're going to come back to me for another deal? No. But if we can make sure that you're successful on your fix and flip, that you're executing it the way you're supposed to execute, that I got to ride Mark because Mark's doing your renovation and I got to bust his chops to get that thing done on time so that you make the most money. Because the quicker you can get that house renovated and put it on the market, the more money you're going to make because the holding costs are lower. Because that's your variable cost are the holding costs when you deal with a guy like me, a hard money lender. So you've got to be able to execute. And so we have a barometer on our borrowers. We really will deal with beginning investors. We love beginning investors, but we love those repeat borrowers that can execute. Because they love us even more because as long as they're executing on their project, they're going to make more money. And that's what we want. Because we're making our money anyway. We don't want your 6-month project to be out there for a year and a half. We don't want it. We don't want it. It's just bad news all the way around. Okay. Can you guys see this okay? Okay. This is a loan builder sheet. This is what I give everybody. You call me up and you say, I've got a property in Dale City. What did I do? Which one am I doing on this one? Oh, this is Oglethorpe. Okay, that's in D.C. That's in Brightwood. Okay, so in this case, they called me up and they said, I'm buying this property in Brightwood for $360,000. It needs $60,000 in renovation. It was a semi-detached house, 2 levels, 3 levels maybe, 2 levels. It needs $60,000 to work, but the ARV is $575,000. They actually told me the ARV was $625,000. I did comps, they did comps. They were at 625 because the square footage was a lot more than the actual tax assessment said. They said it was 1,100 square feet. It was actually a 950 square feet, 425 over 425. So the square footage is a little different. So the square footage in DC is pretty paramount. So the ARV was $50,000 less. I sent them my comps. I said, look, the ARV is only 575. They agreed. So then what I do, so I got that basic information, right? So what I do is I come down to number 2. I then put my parameters, LTV of the ARV, which in this case 70%. I don't feel comfortable going to 75% on a 1930 house in Brightwood, so I went to 70%, 402, 500. Then I said, well, I'll give 95% loan to cost. What's that number? Well, that number is 400, close, 399. So now I have a top number of 4025 and a lower number of 400. Well, that's pretty cool. I'm the kind of guy that I like to be on the button. So I said, okay, I will do a loan number 3 at $400,000. Okay? So remember, he's buying it for $360, $60,000 renovation, so the loan to cost is $420. I'm giving him $400,000 of that $420. It's more than 90%. It's like 95%, right? So I'm giving him all his money on the leverage standpoint. So then I put out a sheet that says down payment, 20 grand, closing costs, approximately 20. So all you got to do is bring $40,000 to close this deal. And oh, by the way, you've got a built-in deal spread of $155,000. So you're only bringing $40,000 to make $155,000 profit. You're getting your 40 back, plus you got 155. So that's a pretty good rate of return. Now, out of the 155, it's going to come holding costs, right, paying me every month. It's going to property taxes, insurance, utilities. In this case, there was no HOA condo fees, and that's basically all your holding costs are. And that's it. Okay. So the quicker you make it, the more that 155 you're going to put in your pocket. So I think in this case, I don't know if I have the out price of that guy. It's in the MLS. It's 209 Oglethorpe Street, so you guys can see the out price. It's there. All right. Oh, wrong way. All right. Advantages to hard money. And I'm almost done with the hard money piece. See, I told you it was going to take me forever. You can close in 24 hours or less. Leverage, right? So if we're true investors, you're using us to rent our money for the leverage. You get approved on the phone with your hard money lender. It's usually me. I can't tell you how many people call me up, and I'll literally sit down there and we'll run comps together while we're on the phone, and they'll tell me everything they need to tell about it, and then I'll say yes, usually on the phone. Think of the loan as renting the money, right? I talked about this earlier. No prepayment penalty, which is beautiful. So if I put out a 9-month loan, you're in and out in 4 months, you're only paying for 4 months. Some lenders, that's one of the things that you got to ask these guys. If they're saying themselves as a private lender, hard money lender, ask them if they have a prepayment penalty. Some of these guys do, because they're selling their loans off to New York, Wall Street. Wall Street has a requirement that they have to have the loan out there for at least 3 months. So that's a pretty important question to ask. And I think, okay, disadvantages. There are none. I'm just kidding. High interest rate points. Okay, 12 and 3 usually for us, 12% interest only, 3 points. Shorter term loan, that could be a different disadvantage if you're not executing your project correctly. If you're doing a buy and hold loan where I'm giving you financing for 9 months, something happened with your refi, could go longer than 9 months. You don't want an extension fees. So you don't want to keep us out there longer than we have to keep. And another reason why you don't want to keep us out there long enough is because our interest rates aren't low. All right, any questions?
When you said you refinance out of your loan, are you gonna keep? Are we going to like Tim, or are you keeping that? So you're going to Tim, okay?
You do DSCR, right?
Yeah.
You're going to Tim.
So it converts to DSCR.
You can convert DSCR or traditional, depending on whatever makes sense.
You want traditional if you can get it.
Sure.
You want it. You don't want DSCR, but you need that avenue. Yeah, go to Tim.
Traditional is DTI. It can DTI for traditional.
Correct.
Okay.
But if your property is LLC, you probably go to DSCR route.
Whatever Tim says.
Do what Tim said.
Yeah, because on the, and we'll cover it. We'll cover it. Don't worry, we'll cover it. If I
I
get,
just want to put out one more advantage of the hard money. So I don't think you spelled it out, but if you had went traditional
Right, right. And not only that, but in most cases, traditional probably won't finance any of the renovation. And so the beautiful thing about us, like if you do, was it a 203K loan or something, FHA, if you do one of these government-sponsored loans, man, there's too many headaches with the renovation piece. And you don't want it. You want somebody, as long as we have a trusted relationship with the contractor, then you want to use us. Because we got draw schedules. And the other thing that we do, so let's say you have it. You guys know what a draw schedule is? You don't know what that is? No. Okay. So let's say I have that same house in Dale City, the 5-bedroom, 3-bath house that needs, we'll say $75,000 in renovation, maybe a little low. It depends on condition. Well, what we do is we take that $75,000, is we'll break it down, and it's whatever Mark says, we'll break it down to maybe 3 draws of $25,000. The contractor has to stipulate in a 3-draw schedule what their draw milestones are for the first $25,000, the second $25,000, and the third $25,000. So them as a contractor, they have to meet those milestones. So for example, the first $25,000, let's say it's a loaded house, clean up. Let's say they got to move some walls around, right? Huh? Demolition, right? Clean out, demolition. Maybe they got to bring it down to the studs. You just never know. So they're going to tell me what they're going to do for that first 25 grand. Now for us, you already have that $25,000 in your pocket as the borrower. So then you need to keep your contractor, keep them honest, and then you'll give them the 25 grand. And then once that first draw is done, you give them the 25. I'll then draw you out, pre-draw on your second draw milestones, which might be painting, right? It might be mud work on the drywall. It might be getting the bathrooms ready, right? Depending upon what you're doing. Maybe there was a roof on the first 25,000. Maybe there's windows, right? So you guys, we're all going to work together to make sure that your deal is straight, right? So just like when you came to me and you told me that you're going to renovate that house in Petworth that cost $210, you're going to do it for $80,000. I'm going to say no, you're not.
Yeah,
Okay.
Charlie, I think that's another thing. Out of your humbleness, Charlie, I think you're missing one other point about hard money, which is a little bit specific to you and Sam, is the bank, which you'll get to in a second with the soft money. Because they have so much of your money in the deal, and they've got so much of a cushion, they're not going to look at the deal in the way that you are, because your money's much closer to being on the line. It's all based on the asset and the ability to fix it. And so you're providing a lot of value in assessing the deal.
Yeah.
So that, particularly for a new investor, they think they found a great deal, but you have the experience to know that kind of property might have mold, that kind of property might have issues that you think you can expand it, but you can't expand it. And a good hard money lender may be like that, but it's better in your situation because, like you say, it's 100% of your money, and the person's going to get that. You know, if you don't want to do the deal, they probably shouldn't want to do the deal either. There's a good chance that that they're evaluating it wrong because you've got how many hundreds of houses have you flipped or done loans?
Well, I'm glad you brought that up. That's a good point, and I'll write you a check later. So some folks have actually they've gotten upset with me about turning down deals and telling them why, especially on the DC front, because very few people know how to do renovations in DC because they're full guts, and so they get mad at me right away. But then maybe 2 or 3 months later, when they've either maybe did the deal with somebody else or thought about it, they then come back to me and appreciate the honesty. You'll be surprised that as long as you give 100% honesty to people, good or bad, they'll appreciate you more for it, especially the bad stuff, because you're being upfront with them. And what people don't realize is that, why do I want to chase away a deal, right? I mean, it's money, right? Why am I chasing away money? But in all actuality, I'm chasing it away because, Mark, your first deal, I want you to do 10 or 20 deals. I don't want Mark to do one deal and fail or even break even, because if Mark breaks even, he spent 6 months breaking even, doing all that legwork, he didn't make any money, he's not going to be a happy guy. So if I could have turned him away at the very, very beginning, we'd have a happier Mark.
Let's say this too. I've done a lot of 203K Wells Fargo loans, DC, a lot of them, right? And so the question I'm asking you, we had inspectors, and an inspector come through, and I'm not talking about the DC inspector, I'm talking about the money inspector, the guy that gets you the draw. So are you saying, in a case like this, where you're loaning the money, you need to make the client, to me, the inspector? before they give a draw?
Yeah, we do it. Sam does it.
Or are you coming out?
Yeah, we're coming out.
You ain't come out on me.
It depends. Okay, hold on. It's two-pronged. It depends. If you're in DC and you're pulling permits and there's certain milestones for the permits, then you're either going to send out city inspectors or third-party inspectors to get you through the permit
I'm
process.
not talking about those inspectors.
For draws, it's us.
Right.
For draws, it's us.
Yeah.
We're doing it. Yeah, we're inspecting it.
How long they had an inspector
Yeah.
to get the draw, to a certain amount
Yeah.
of money. Like
We're doing it.
Right.
We're doing it. So if we're using a contractor that we know, they're sending us pictures. Matter of fact, they might not even do that. They might just say, okay, draw one's done, I need draw two, because we have such a relationship.
Well, I did that with Sam.
We have a trusted relationship. Like you're calling us up and saying, I'm done, send me the money. We just send the money. But if it's a contractor that we're not familiar with, then Sam, not really me, Sam is pretty much showing up on site. Because especially after the first draw, the most important thing for us is draw one. Because remember, we've already pre-drawn. So we need to make sure that draw one milestones are complete and that we have a trusted relationship with that new contractor so that we can send out draw two. Because if that contractor hasn't done what he was supposed to do in draw one, you as a borrower are not getting draw two. Because we have found out that there was problems with this project at the very, very beginning. And so then we got to level set and we got to figure out, okay, do I need to take over this project? Can this investor who's managing their project and this contractor, can they get us over the hump? And so we rely on them to fix their problems. And if they don't, and it's good for us because we find out right away. I'm talking first month into the project, and we want to know that, right? Because my ARV has been predicated on real-time data of the marketplace within the last month. I don't want it to go out any further than that. Because if we get caught up in a downward trending economy, kind of like in DC, then if I wait 6 months before I call a bad project a bad project, I could be in trouble. And so we kind of thwart this out at the very beginning. Okay. Good? Sorry, I'm taking a little longer than I thought. Soft money. You guys familiar with soft money? All right. What is that? Are you guys familiar with community banks? You guys know what a community bank is? Virginia, we got Burke and Herbert. We have Sandy Spring. We got Freedom Bank of Virginia. We got Fauquier National Bank. Any kind of small bank that lends within a community, that's what that is. That's soft money. Okay? And so what they do is that they don't just lend on the asset. You've got to be bankable, right? Their interest rates are going to be lower, but their leverage points are also going to be lower. But you're going to have to submit them tax returns, you're going to have good credit score, and you're going to have an LLC, and then it's a bank to LLC loan arrangement as well. But on a fix and flip, most of the time they're only going to give you 75% of the purchase price, and then you've got to carry the renovation. But it's cheaper interest rates, okay? Why do we talk about it? Why do we bring it up? Because if you guys have a little bit more money as borrowers, you might want to go that route on a couple of your projects because it is cheaper interest rate, okay? A community bank derives its funds and lends to the community where it operates. It used to be that a community bank in Virginia was just in Virginia. Capital Bank in D.C. was just in D.C. Revere Bank, Congressional Bank were just in Maryland. But now we've gotten to the point now where, like, for example, Sandy Spring started in Maryland. They're now in D.C. and Virginia. So these community banks are starting to cross-pollinate. But it is a relationship-based business. You are going to have a commercial loan officer assigned to your account, right? Generally, they lend in one state, but like I said, they're starting to cross-pollinate. Sometimes it used to be the community banks used to have 1 to 5 branches. There are some community banks that are online only. They might have 1 branch. So you just got to get to know your community bank. So I would start a relationship with them because it could help you. And also, too, the reason why they're called community banks is because of the asset size, $50 million to about $2 billion, I think. And so that's important. It's not important to you guys right now. It's important to us because the asset size of a bank correlates to how much their legal lending limit is per client. right? So Freedom Bank of Virginia, for example, maximum they used to be able to go to is $7.5 million. And they were at, I think, $750 million in assets. As they grow, the legal lending thing grows. Why is that important? Because guys like us, we need much bigger relationships with our banking partners. And so let's say if I need, I don't know, 20 million bucks, Freedom Bank can only do 7 million. I've got to get a few more other relationships out there because that's what I need. We're just but that's why you guys need to know that as you grow. Soft money banks, another reason why you use them, they offer lines, fix and flip lines, buy and hold lines, hard money lines, very rare, I'll get into that in a minute, commercial loans in nature. The interest rate is based on prime plus a margin. The margin can be negotiated. I think now it's called the SOFI. It's the SOFI. That's what it's based on now because the LIBOR has since kind of retired. And then the lines are evaluated annually. So when we first started on our fix and flip business, you guys are going to laugh. We needed a commercial lending partner, a community bank. At the time, this is circa 2004, Sam literally went through the yellow pages under banks to find the community banks. Well, one of the banks that he found was Burke and Herbert Bank, a loan officer by the name of Joe Collum. Sam then went to the internet, looked up Burke and Herbert Bank, and there was somebody who sat on the chairman of the board. His name was Charlie Collum. So Sam was like, oh, well, Joe Collum, Collumn, Charlie Collum, same last name. I bet they're related. We're going to go talk to Joe. So we show up, and at the time, we had done a couple flips, 2 or 3 flips. But we had another flip that we wanted to do, and we wanted to get borrowing money to get the flip because we had been using our cash, our HELOCs, money that we didn't really have that we didn't want to get leveraged. And so we started a relationship with Burke and Herbert Bank because of Sam thumbing through the yellow pages. And that's how we found them. So we established our first fix and flip line. So we had to bring in a portfolio of the 2 flips we did, before pictures, after pictures, a description of each deal, how much money we made. But then we had to have tax returns, LLC tax returns. We're fairly new. We had to have personal tax returns. Both our credit scores had to be good. We had to have what's called a PFS. You don't know what a PFS is? Personal financial statement. You had to have that. So we had to have our assets, our liabilities, and our net worth. We had to learn how to be bankable. That's what you guys are going to have to learn, too, is to be bankable. They also, the other thing, too, lines are evaluated annually. We ended up getting a fix and flip line of $750,000, 3 250s. So the maximum that we could use for exposure was each house was $250,000. And so that helped us out tremendously because that gave us a leverage that we were kind of looking for. So we got that. And then over a period of time, we started getting rentals. I needed somebody to refinance the rentals into, so they gave us a buy and hold line, right? And then as we continued on with our relationship with these guys, 5, 6, 7 years later, we got into the hard money business, and it's a cash business, so it's a very high intensive cash business, so we needed more leverage component because we kept running out of money. I kept saying yes to deals, even though we didn't have the money, so we had to raise money from investors, we had to have credit lines, and so it was just a struggle over the first few years of that hard money business. But community banks are you've got to learn about that. We talked about some of this stuff. What are the things that they're looking for when evaluating an investor? Like I said, how many years in the business? Remember, we were only 3 or 4 months into the business. We were lucky that Joe Collum and his father Charlie knew each other, and he had a little bit more leeway than a normal LO would do. Money down, they're going to look at your liquidity. How much money you got? Personal net worth, I was talking about PFS, right? Taxes, both business and personal. Credit score, your financial house has to be in order. I guess I got corporate taxes on there twice. I apologize, but those are some of the things that you guys need. Large tier banks, Atlantic Union, Sandy Spring. Sandy Spring was $11.2 billion. Small tier, Revere Bank, Burke and Herbert, John Marshall, Capital Bank, Congressional Bank, Freedom Bank of Virginia, FEC Bancorp. At the time, Freedom Bank of Virginia was $550. Back there. So the bank that we had used the most, Freedom Bank of Virginia, at that time was $550 million in assets. Now they're up to about $750. So our legal lending limit, we kept topping up. So each quarter, as they would raise more assets, we would go in for a higher legal lending limit because we needed it, because we were doing a lot of stuff. Advantages of using soft money, interest rates, right? Nowadays, maybe not so much because all these indices are climbing, right? So I think now, Ed, what is it, 8.75 roughly?
Yeah, but that's for a very qualified borrower.
Right,
So
right.
It's gonna be a little bit.
Probably 9.25 to 9.5.
No, it actually 9.25.
Is that where you are?
Would be, yeah. And then,
Yeah.
So you're talking into 10 for a lot of it.
Right, and remember though, you got to be bankable, so it's a pain in the ass. Excuse my French. It's really tough.
There is, I mean, Sam does a lot of that paperwork, but it is a lot of.
It's a lot of stuff.
with that information.
Yeah, and the big thing is though, is that you got to renew your lines annually. So you got to give them the same paperwork every year. Now, if the bank's management changes or they get bought out, like community banks do, they might discontinue your line because they don't want that. They don't want that product anymore. They don't want to do fix and flip lines. They don't want to do buy and hold lines. So that's why it's very important that you just don't get one community bank relationship. You have 2 or 3. Okay? Disadvantages, documentation, annual review, 25% down payment, continual bank mergers and acquisitions, and they're changing loan appetite. So you've got to keep that top of your mind, okay? That's really important. I think that's it for that. Okay? Any questions on community banks before I get into sub 2s? No questions? Y'all learning something? Y'all need a break, coffee break, Coke break, any kind of break? Am I good on? I have no idea what time it is.
You ever heard of Industrial Bank?
Yeah, they're
DC.
they're good. So I'm doing all right. Okay. Should I cover this subject too? Okay. All right. The next type of financing I want to cover. Remember, guys, I'm coming to you guys with and only with my investor hat. I'm not coming to you guys from consumer loans and mortgages. This is just money sources, different tranches that you've got to get and know as investors. Subject to financing. What is it? You guys know what it is? Some of you do? All right. It's a form of financing where you take over the existing loan. I didn't say assume. I said you take it over. Subject to, what subject to means is subject to the existing mortgage, okay? So the way a deal happens is that the deed transfers, you're the owner, I'm the buyer, you sign off on your deed, okay? You have a mortgage on there. I'm going to take over payments of your mortgage, but you're still going to be on the mortgage, okay? That's what it is. There's no formal bank approval process. The purchaser investor takes over the payments. Caveat, you guys got to understand this. Most loans, matter of fact, I don't think I've ever seen a loan that doesn't have this. They have a due on sale clause, okay? Lender has the right, but not the obligation to call the note. It's called a due on sale clause. So if the lender finds out that the deed has changed hands from a different buyer to a different buyer, then they can call the note. Ask the question.
Have you ever experienced that?
Thank you. No, it's never happened. I've never experienced it. Okay? There are, you guys know what an insurance company is, obviously? There's this company called an assurance company. ASSURANC, assurance. You can apply to them. They're going to collect an assurance fee to guarantee you that if that due on sale clause happens and the lender calls the loan, they'll take it over. They'll take care of it. I want that company. Okay, I'm an assurance company. I'm clear. Ed's going to start it. Ed, Clear Sky Assurance? Sure. Get it going. Okay. Here's the other thing you got to understand. The purchaser incurs no liability on themselves to pay the loan. What I mean by that, if the loan goes bad, you're still under obligation because it's still in your name. Okay? Something to learn, but I'll tell you why it doesn't happen in a minute. Some of the things that we do, matter of fact, we probably should have, we don't have to do that in your deal. Have them sign a POA to allow us to talk to the mortgage company on the final payoff, because we don't need to worry about that with this guy. But sometimes you'll have the seller sign a POI appointing us buyer to talk to the loan company on your behalf, because you're going to maybe need to do that, especially if it's a fix and flip. Okay? And so that's basically what it is. Pretty simple, right? Why are we talking about this, guys? Talk about this in a minute, huh? Yeah, we're in a high interest rate environment. We're doing a deal tomorrow, subject to, on a VA loan, where the interest rate is 3 7/8.
I have a question.
Okay.
So the seller, are they tied, are the DTI tied to that house? Can the seller buy another house if they already have a loan and their DTI is like right there?
They can, but they're going to have to prove some income. They're going to have to prove the income.
Because their loan is already
Yeah. But we're responsible for the payment. So I guess they would just say, even though the payment's not going to them, the bank would, well, look, they would do 75% of the payment, and then 25% is considered debt, right?
So you're saying like a hypothetical rent on it? Yes, I know when,
Because the payment's $2,000. We are making the $2,000 as a subject to buyer, but the $2,000 really isn't going to the seller. But yeah, I'm not sure how that works actually. I don't know that answer.
Yeah, so the seller may not be able to buy another house. Where
Potentially.
it is.
so we have, at our launch meeting, we had an expert on subject to speak. I think you were here
Yeah.
when Nia spoke. So we've got that on YouTube, and she talked about, and I don't want to misspeak, right? Because we're talking about fix and flip, long-term rentals. She does kind of like a couple of year rentals and then sells it as her exit strategy. She talked about corporate rentals or like a corporate lease agreement to
Oh, I see.
similar to like an
I see.
AAV arbitrage
I see.
type deal. So that way the seller.
So the income is documented.
Yes.
So you have the income documented.
Obviously,
Yeah.
we don't want to do anything. We want to stay above board.
Yeah. Income documented. That's a good idea. But they don't own the house anymore. But that's a good question. I'll have to
So
find
I
that
have a
out.
question. So on subject to, obviously, you'll get the deed, probably the buyer would get the quick claim deed in their name, right? Would you do anything with the insurance that's on the house?
Yeah, we'll get a new insurance policy in our name. And that's usually the kicker that says
Right.
the house is,
okay.
yeah.
Yep.
Because then but what happens though is the servicer finds out about it. It's hard to say if the servicer is going to report that back to the lender. But the reason why none of these loans have been called is because just make sure the payments are current. Make sure all the payments are current. Don't miss a payment. Make sure that, they're going to make sure the property taxes are paid. Make sure there's insurance. Don't let the insurance expire. Just don't do things that would put the bank, have a reason for it to call them out.
Well, the insurance needs to have the interests of the
Right.
lender still in it.
Well, no-
So that's.
Well, yeah, but not only that, but the insurance has to have you as the owner, so that in case there is a fire, you don't want the old owner to be on that insurance. So yeah, so the answer is we're getting it right away. Yeah.
So I heard that it was recommended that you hire a servicing company that collects it from you and pays for mortgage.
Well, in our case, we just pay, and I'll go over some examples. We just pay it directly to the mortgage company, the servicer itself. The difference is the check is going to be different.
When you say we, you're talking about Clear Sky?
Yeah.
Because when I think of subject to, I don't think of using a company to help me. So I'm the buyer,
Right.
and I don't need financing. You're saying you are also the buyer in
Yeah.
your case. Okay.
Yeah.
Okay.
And so I'll go through a couple of, these two examples. I'll go through these examples, and then we'll probably have a few more questions. So the first example that I'm going to go through is a buy and hold. That's a subject to. And so I need to set the stage. So the background, and this is in Culpeper. I didn't give you the exact address because the investor still owns it. In other words, I did this deal, and I'll tell you what I did with it. She still owns it. Single family house, 3 bedrooms, 2 baths, 1998 built, cookie cutter subdivision in Culpeper, right off of 29. The house was in pre-foreclosure. Key, right? Because most of these subject twos are going to be, they're going to have some level of distress. In this case, it was a pre-foreclosure. The one we're buying tomorrow, the guy just moved in with, it was a family change. He had a personal change in his life, some water damage, some of those things. He was kind of a classic don't want her. In this case, it was pre-foreclosure. The original loan was a VHDA loan for $218,000. We all know what that is, right? First time Virginia home buyer program. The origination date alone was 2015, 3.75% interest rate, 30-year AM schedule. Keep these things in mind. I know it's hard because I'm going to go to another slide. The loan arrearages was $44,002. This person hadn't made payment for about a year and a half. It was a COVID. What happened was he lost a wife. He moved back to New Jersey to be closer to his family, became a don't want her. However, the taxes had his New Jersey address. That's how we tracked him down. November 8, 2021, if I were to bring it current with the $44,002, the principal was $192,500 at the time. Okay, it's important because I'm about ready to put all this together. Okay, the owner. So we showed up at a Wells Fargo bank in New Jersey, and the reason was because I had accounts with Wells Fargo. We met the owner. I had a deed ready from the title company. I had Rick Oppenheim, another lawyer, send me a deed, right? Buyer name. We had the owner show up at the Wells Fargo. Actually, we went to his house and put him in the car, drove him to the Wells Fargo with the deed in hand. The owner signed the deed, had it notarized. We gave him a cashier's check for $10,000. I then had the information of the substitute trustee for the $44,002 that they needed to get because the foreclosure sale was happening 3 or 4 days later. We wired the substitute trustee $44,002 from that same Wells Fargo in New Jersey. They canceled the foreclosure sale. Okay. We now own the house. Not we, this investor did. I put the second trust on the house for $54,002 because I'm the one who funded the $10,000 and this and this. Okay. So I had the second trust on top of a subject to. The after repair value of the house was $375,000. They're buying it for $246,502. How did I come up with that number? Remember, I said the loan balance was $192,500. Once I paid the $44,200, I brought it current. The AM schedule was $192,500. That's what was left on the mortgage. $10,000 to the owner, $44,200 in arrearages. The total purchase price was $246,502. We did it outside a title company. I probably owe some deed transfers and that. No one's called us up on it. After repair value, $375,000. Now, if you bought a house for $246,000 and the ARV was $375,000, would you say that's a good deal? Yeah. It's a good deal, right? It's a great deal. They got $125,000 in equity minus some rental renovations. Because remember, I told you, 3-bedroom house, 2 baths, 1998, 1 level, but it did need to get some rental renovation because we had to get it ready to rent out. The payment on the loan was $1,365. This is a buy and hold deal. The rent payment was $1,950. Okay, you subtract $1,950 from $1,365, PITI, right? Positive cash flow $585. Now, if I told you that you bought a house with $100,000 of equity, because remember, it costs about $25,000 to get it rental ready. So you have $100,000 in paper equity adding onto your balance sheet, and you were making $585 positive a month, positive cash flow. What would you say to that? Hell yeah, right? Great. So that's what happened. That subject to deal is still out there to this day, VHDA. Still out there. And it's been almost 3 years.
Did you mention that the seller still owns the house?
No. The investor owns the house. The seller's still on hook for the house. But it gets better. Yeah, about $25,000. Get it rental ready. Yeah, yeah, because it had been vacant for about a year, so it needed. I think it needed a roof. It needed carpet. Needed some paint. Appliances were okay. Countertop, it's a rental. We're not replacing the countertop. We're not replacing the cabinets. So it needed about 25. But so that's a pretty good deal. And that loan is still up to today. Now, you guys are saying, well, the owner is still on liability of the loan. Well, guess what? By making those payments every day, we're actually helping his credit. His credit's going up, right? He had a default on his. He almost had a foreclosure. But since these payments have been made for 2 or 3 years, his credit's going up. Now, why does he not care? Because the house is worth $375 ARV. The loan only owes $192.5 3 years ago. We're further into the AM schedule, so the bank probably only is owed $185 because it's probably come down about $7,500 in a couple of years. So you got $185 is owed on the first trust. After a repair value of $375, what are the odds that that new owner is going to get foreclosed on? Close to zero, right? Come on, let's be real. That's not getting foreclosed on. So there is the risk to the owner who still is on obligation for the debt. There really is no risk, because even if the house goes to foreclosure at $375, multiply that by 70 cents, whatever you get is almost $280,000. Somebody's going to bid at least $275 to $280 at the foreclosure auction. It's going to pay off the entire debt. There's no obligation owed, no liability to the former owner. So not much of a risk. Get it? Y'all understand that? Okay. All right. Here's another subject to deal example. Instead of being a buy and hold, this is a fix and flip. And the one that we're doing tomorrow, where we're doing a subject to deal tomorrow on a condo in Taconic Circle in Dumfries, it's going to be a fix and flip, right? So even if the due on sale clause ever did come to play, it's going to be 3-4 months before they ever do it anyway. The house is going to be flipped out and they're going to be paid off. No big deal. But here's another deal. And this is in our backyard. And I put the address. And the reason why I put the address on this one is because the house has already been flipped. I don't care if I disclose the seller. Plus, the seller is a single-use entity LLC anyway. So y'all going to have to do a little bit more research and look it up on the internet to get the seller anyway. 3218 Birchdale Square. Here's a scenario. N-unit, 2-level townhouse, 4 bedrooms, 2 full baths, 2 half baths, 1968 built. But again, it's in a cookie-cutter subdivision. The house was a rental for 20 years, so obviously out-of-town owner. The renovation budget was $50,000. The original loan in 2013 was $133,900. This deal happened around April 30th, 2020. So the pay down of the $133,900 was down to about $120,37. Okay? You guys got that? So remember 120, about $120,000. So remember that. Purchase price was about $168,336 because he gave the owner some money, right? He didn't just subject to it for 120. He gave the owner about 48 grand, right? Like I said, remember, the subject to 120. So 48,000 went to the seller. Seller closing fees included, right? Because this buyer did pay for it. So the seller walked away with $48,299. But now he owns the property for $168. The after repair value on it was $295. So what happened? We came in as a second trust hard money lender. We put $75,000 on top of that 120, so it covered the renovation, $50,000, the entire renovation, and it covered 25%, $25,000 of the $48,000. So roughly, this buyer brought about $25,000 of his own money. But remember, though, the renovation is already covered with our second trust. So here I am as a hard money lender. I'm a second trust of a subject to first. That's great for the borrower because he's paying only $75,000 of my high interest rate. And he's paying a lot less to carry it on the loan that's $120. I don't remember the interest rate on it. I mean, it was originated back in 2012, so whatever the heck interest rates are for that, I don't remember. It's certainly cheaper than mine. Hey, that. So he flipped out of it for $293. Didn't hit the $295, but he got close enough. So whatever that is, $293. So he walked away with, let's say, $130,000 in profit. Right? Not bad. So that's a flip example of a subject to. Advantages, you guys know, right? Interest rates. The most powerful thing, though, is right here. You're further into the AMP schedule. Remember the buy and hold that I talked about? That loan was originated in 2018. Now we're in 2023, so we're 5 years into that AMP schedule, so a little bit more money is going towards principal. If you can get a subject to 10 years of AMP, then you're even in better shape. But that's very important to learn on subject twos. Minimum down payment, if any, right? The first deal I talked about, that the person that bought the buy and hold, they came up with no money out of their pocket. The only money they spent was the $25,000 to get it renovated, because I carried the entire second trust plus subject to on the first. Same with the second deal. They only came up with 25 grand, right? And they made 120, whatever the hell the number was. Disadvantages? Remember, the bank can recall the loan on an ownership change. Assurance. I wouldn't waste my time with it unless you're going to pay Ed right out a check. He'll assure it. Former owners still on the hook for the obligation. That's about the only disadvantages, guys. It's a wonderful tool. How to find them? People like this. How do we find them? We have bought many subject to deals, even though we didn't realize they were subject to, because we've purchased second trust at the courthouse steps, and we've just paid for the second trust. We own the house, but we kept the first in play. We've done that a bunch of times. Okay? So pre-foreclosure ads are good. Out-of-town owners, realtor referrals, right? You realtors, realtor referrals. Subject to mailers, but I would focus your list on the subject to mailing to mortgage originations between March 2019 and March 2022, hovering around under 4%. Why did I put March 2022? That's when what? Yeah, and that's when interest rates started going up, right? So 5, 6, 7s, 4s, but if you put your mailing list in between there, but you want to, right? So I think the key is out-of-town owners. So if you guys are buying lists from ListSource or wherever you're buying lists, where you want to focus on it, out-of-town owners, and then purchases or refis, doesn't have to be a purchase or a refi, between those dates, that should get you a pretty good list. And then mail them out. Okay? And that's how you might be able to find good subject to deals. Obviously, we want to do maybe driving for dollars, right? That's the freest form and best form of marketing. Look for some vacants and blighteds. And then, if you do blighteds and you get a phone call, just do a title search on the origination of the loan. But you might not care if somebody's a distressed seller and they're calling you up. You care less about subject to. If it's that good of a deal, you figure out other financing ways to do it, okay? Okay, any questions? We good?
For that first deal, I looked it up on the assessment site. They only held it for 2.5 months. Is that not common?
Say it one more time.
For that first deal, they only had it for 2.5 months.
It's perfect.
So
It's great.
there wasn't that much.
Right. Right. So then part of the process that I should have explained better was 2.5 months later, when they went to flip it and close it out, the title company had to call that mortgage servicer and get that final payoff. If you don't have that power of attorney, or if you don't have the last 4 digits of the Social Security number and the birth date of the original owner, then it could be kind of challenging to get it. But these title companies are resourceful; they'll get it. Yeah, that was only a 2.5 month deal. The first deal, though, the VHDA loan, it's still out there, and the investor is making the payments online, still to this day. Okay, anything else? I'll move on. All right, owner financing. I'll go quick on this because I want to get to something as a subtopic to this. We all know what owner financing is, right? Okay, I got a question for you guys. Owner financing, is it first trust only? So usually in the old days, an owner financing deal was where the owner has owned the property outright, right? They would sell it to you in what's called an installment sale. You would get them to create the note. Okay, that's the old moniker, right? That's an owner finance deal. Well, in today's day, we could do an owner finance deal subject to the first, right? We could have the owner hold a second trust and then subject to the first. So then you're making 2 payments. Okay, that's an owner finance deal. Actually, there's a chart before this. I must have went too fast. Okay, because I didn't explain it. Owner owns the property outright in most cases. Owner provides the financing. The best part of that is the rate and term are negotiable and your down payment's negotiable. Okay? Escrow loan, question mark. Most of these guys aren't set up to do escrows, so you're going to have to make him the principal and interest payment or interest-only payment, depending upon what you negotiate, and then you're going to need to pay the taxes and insurance on your own. Okay, non-escrow loan. There is a recorded deed of trust or a mortgage. Remember, that mortgage could be a second trust or a first trust. Just depends on the title. Because if the guy's holding financing, he might be okay you doing a subject to on his first, provided he can get a higher price. I've seen certain owner finance deals where, let's say there's a property that you want to buy as a rental, right? Let's say it's a house in Deal City that's in absolute terrible shape, and the house maybe have an ARV of $400,000, and the owner wants $400,000 for it, but you know you're going to fix it up and know you're going to rent it out. Well, maybe in order for you to win the deal, you'll give this guy an owner finance deal of $375, right? But you're going to have him carry financing. But let's say you know that you're going to put a tenant in there, paying you $2,500 a month of rent. One of the things that you might want to do Give that guy his $375. Negotiate a first trust at $375, but with 0% interest. Give him what he wants. Negotiate that term, 0% interest. What does that mean? That means you got a tenant in there, right? You're going to rent it out. He's going to pay $2,500 a month. You're $2,500 a month. Whatever that $375 is, let's say it's a 20-year AM, so we'll divide $375 divided by $240. That's your monthly payment to him. But guess what? Every dollar of your monthly payment to him goes where? Directly to principal. So your tenant's paying you $2,500. Your payment to him might be $2,000. You're putting $500 in your pocket, but that $2,000 is going directly to that $375. So in year one, it's $375 minus $24,000. You're breaking that principal down. But remember, you probably didn't make a very good deal on the purchase. The house was worth $400, but it was in bad shape. You paid $375 for it. But where it made sense was you got good terms on it. Okay? Don't forget that. The terms are the most important part of that owner financing piece, not necessarily the purchase price. Y'all got that? Okay. Going the wrong way.
So in the first and second you were talking about, what happens with title? With the subject to on the first and the...
Title gets a little crazy. So the superiority stays the same, right? The first trust, the superiority of when it was recorded. The problem with the title is that, and title could miss it. The problem with title is title only likes to do the title search on an ownership change, right? So if they only did the title search on an ownership change, the only thing on that owner, being the new LLC, the only thing that's going to show up is that owner finance trust, right? So they're actually going to have to do a title bring down all the way down to the date it was financed when they go to sell it. That's the only time it matters, right, when they go to sell it. Because when they buy it, I'm assuming it's the same owner. So they're going to do the title search anyway on the owner that's selling it. So that will, but the title search is going to come back with just that first trust that they're doing a subject to on. That should be all that shows up on title. The problem is when the new owner goes to sell it and that first loan isn't paid off and that certificate of satisfaction isn't. So there will be an issue with title. But if you guys know that you're selling it and you're doing that, instead of holding it as a rental, you're flipping it, you're going to tell the title company, yeah, there's a subject to on the first. But you're going to have to in most cases because they're not going to be smart enough to go back. Then you'll have a title claim. So yeah, that's a good question. All right, advantages. Interest rates, right, because you're going to negotiate the terms. No application documentation. Minimal down payment, again, negotiate it. Avoid capital gains for the owner, which is a positive, because now if he's selling it, let's say he owns the house outright, and let's say it was an investment property, he'll have to pay capital gains on it. But in this case, instead of paying all the capital gains, it's a what? It's an installment sale. So then he's paying interest every year on the payment that's being made to him and on the principal. So it's an installment sale. He's not paying the entire capital gains on that transaction. Just each year he's got to file his income, right? So that reduces his tax burden. Fast closing, cheaper closing. Where the disadvantages, just like anything else in this business, guys, where the disadvantages, it's hard to find. And usually it's a short-term loan. Usually it's a 5-year balloon or a 10-year balloon. The longer you can spread it out, the better for you. But a lot of times if they're smart, which most owner finance guys aren't that smart, but you want to negotiate that balloon for as long as you can. All right, so that brings me to the next type of owner-held financing. And this is really, really important for you guys to understand this. And this is going to come out more and more. It's called a SAM. A SAM is a shared appreciation mortgage. For you fix and flippers, this is a good one. You guys have probably heard, y'all heard of novation deals? I just don't want to make this too complicated. There's something called novation deal. This is a lot simpler than a novation deal where you buy the house from the owner. Novation deal is where you buy the house from the owner. I'm going to fix and flip it. You stay part of the deal. We're going to share a profit on the upside. So you're going to get the price that I'm paying you for it. I'm going to pay the renovation costs, and then me and you are going to share the profit That's a novation. Okay. This is a similar kind of thing, except it's a shared appreciation mortgage. But this case, let's say you got that same house in Dale City. It's worth $500,000. It's in absolute awful shape, right? You're buying it for $300,000. You're going to put $75,000 into it. But out of the $300,000, the owner might own it outright. But you might, in order for you to win that deal, because you got a bunch of other vultures out there trying to buy that same deal, you might say, well, why don't you hold the mortgage, and then me and you will split the profit, because I'm going to fix and flip it. We're going to split the profit. Okay? So you're going to share. So not only are you going to have a contract that says how much I owe you on the $300,000 mortgage, I'm going to owe you a rate and term, so I'm going to make you payments on your mortgage, but we are also going to share the appreciation after a certain point, right? So then what happens is on the final payoff of that mortgage, when you flip it, he's going to get his $300,000 back plus another lump sum of the shared appreciation, which would be the shared flip. Okay? Y'all got that? Shared appreciation mortgage. And that's a good way for you guys to put in your toolbox to win the deal, especially when you're talking to a 22191 or a 22193 seller of a house that they own outright that's in absolutely awful shape. You can share it with them. But that will win you the deal. And then you got to flip it you don't have. You'll get a low interest rate in return, limited down payment, recorded deed of trust on the mortgage, right? They're going to record their SAM, right? But then the terms of the appreciation won't be in the deed of trust. It will be in the promissory note, whatever you guys set up. But it's a great incentive for you to be partners with the seller, but you are on the deed. The seller's profit is defined in the promissory note of the SAM, okay? So that's a good one to add to your toolbox. All right? Oh boy. Uh-oh. Uh-oh, where am I going? Back, I need to go back one more. Okay. Seller benefits. Obviously, they get the property sold, usually at full price, what they want. They avoid capital gains in an installment contract, but if you're a fix and flipper, though, that's going to have to come back on them. No more payments on the senior liens, if there are any. So if there's you can have a SAM on top of a subject to, but in our case, my example, there's no subject to. It's just a shared appreciation mortgage. And the seller gets to share the appreciation that they probably might not have had. Now, the buyer benefits is it's really good for high price markets and high interest rate markets. Really, really good, right? Especially in the DC area, we're in a high price market. This is very popular in California and Hawaii, okay? Price is less important. Terms are the most important for the buyer, and then the terms are negotiable, especially that lower interest rate. Your carrying costs are much lower than having to deal with a hard money guy like me, okay?
I was just going to share on this second part of that.
Okay.
You're going to see more of that in the primary residence space too. Specifically California, I saw recently where there'll be products that come out that have shared appreciation as a primary residence.
Yep. Why am I covering this with you guys? The answer is simple, right? I'm covering it because obviously I'm a hard money lender, right? But I'm covering with you guys because, remember, I've got my investor hat on. I don't have my hard money hat on. I got my investor. You guys have got to know you've got to put all these financing tools in your pocket. So why do they do SAMs, right? We talked about this. For flippers, people looking to fix and flip, it's perfect. They share the future appreciation of the home with the new purchaser. Good. Now, where these things started, believe it or not, they started in the 2009, 10, 11 crash. Because these things were called loan modifications. In order for some of the servicers to modify your loan, I think it was HAMP, something else, they would modify the loan, but they would put an appreciation clause in there. So as the house goes up in value, even though the principal was reduced, the underlying investor used it to get appreciation into the future out of the final payoff of that mortgage, so they didn't get killed and take a bath. That's where it actually started. It wasn't called SAM at the time. It was called something else, and they shared the appreciation. HARP, HAMP, yeah. All right? Any questions on owner financing or SAMs? Any questions? DSCR. Should I cover this? Okay. You guys know what a DSCR is? DSCR stands for Debt Service Coverage Ratio Loan, right? It's a type of loan for buy and hold investors. It's an LLC to LLC loan. And so there's two prongs on this. The income of the property stands up on its own, but the rent could be a normal rental, right? 1 year, 2 year tenant. It could be a VRBO. It could be a Airbnb. It's the income. It could even be a room by room house hack. You just got to document your income. Some lenders have different requirements on income requirements, so you got to be careful there, especially if you're doing Airbnb, VRBO. Lenders, if you don't have a tenant in there, lenders will accept the annual rents market, provided you can prove it in the MLS. They'll accept that. But if you are doing short-term loans, there are other qualifying criteria. It could be done on a single property or a portfolio of properties. We recently did a DSCR loan with Sandy Spring Bank on a 50 loan portfolio. We closed it, luckily for us, we closed it last June before the interest rates really started to spike. So we've done DSCR loans ourselves. They're LLC loans, 20 to 25% down payment. And I need to caveat that. If you're doing a DSCR loan from scratch right away, they're going to require a big down payment. But if you've already bought it and you've renovated it and you've got a renter in there and you've owned it for 6 months or more, then they'll use a stepped up appraisal to maybe take that requirement out, so you're not going to have to bring much money to closing. It just depends on how much you bought it for and what the new appraised value is. They're going to probably require 3 to 6 months interest reserve in your bank account for liquidity. Currently, you need to have at least a 660. Has that changed? Is that about right?
It's about right, yeah. They're varying levels, but much clunkier than hard money for sure.
Right. So it used to be a 660 credit score. It might be 680. I don't know. It changes. The good thing about it is, there's two good things. The good thing about it is you can pick your AM schedule. Certain lenders will allow you to pick your AM schedule. So if you want to go 30, 25, 20, 15, but if it's a good cash flowing property and we want the monthly income, we're going to go as long as on that AM schedule as possible. I don't know if they offer 40s. I know they do 30s. I don't know about 40s. And you can have multiple loans, which is really good, because if you do a traditional loans, maximum 10, 6 per bank, right? Like I couldn't go get a traditional mortgage to this day. I got too many mortgages in my name. I don't qualify because I don't. But at LLC, it doesn't matter anymore. Okay. Oops. Yes. Okay. What is the DSCR? Debt service coverage ratio. So we all know from school, it's a fraction, right? So if I go 2 over 1, 2.0, right? If I go 1.5 over 1, it's 1.5, right? 40 over 20 is 2, right? So we know it's basically a ratio. And what they do is they take the income of the property and they divide it by your payment, principal, interest, taxes, and insurance, plus condo fee, plus any HOA fees, and that's the bottom, numerator or denominator, right? That's your denominator. Numerator is the income. And they come up with a ratio. Well, in this case, I had a $2,500 in rent. I had a $2,000 payment. Well, my ratio was a 1.25. And these DSCR lenders will equate interest rate on a couple things. The higher your DSCR is, the lower the interest rate is. So the more income you have on the house, the higher your DSCR is going to be, the lower your interest rate is. So what they do is they qualify the asset based upon the DSCR ratio and your credit. And they're going to do an appraisal to see what their LTV is. So there's a bunch of factors that factor into their final interest rate. Got it? Okay. Advantages, flexibility. You can have multiple loans on multiple properties. Remember, I couldn't have got normal financing. We were able to do all of our properties with one bank. No 10 limit rule. Flexible AM schedule, interest rate. Well, again, caveat it, right? With the higher interest rate environment, I remember when DSCR loans were down in the mid fives. Now they're probably up around 7.25, 7.5. They're climbing a little bit. So, right? But it gets your money out of it. And credit score disadvantages. Again, advantages, interest rates, disadvantage interest rates. Shop it, and then you do have a credit score requirement. That's why when I was asking Patrick earlier what his credit score was, and he didn't lie to me, I knew that he was a candidate for a DSCR, right? So I knew at the very minimum he could refinance out of that buy and hold, and I'm not stuck with that loan. Huh?
It has to be under LLC.
Yeah.
How old is the LLC supposed to be? Doesn't matter?
No. Could be created. Yeah.
Sometimes.
Yeah, it can definitely be new, but I mean, you can also, you can do your personal name, but there's really
You
no
can.
benefit.
Yeah, no benefit.
So
I don't know why you would.
LLC, but the credit is your name.
Yep.
This person.
Yep. Well, the credit is, well, again, certain banks have certain requirements. Managing members, if you have two 50% managing members, are going to need both credits. I think it's any managing member over 25% owner, right?
Yeah.
Depends on the bank. Depends on the requirements. So if you have four 25%ers, we're all four are going to need to pull the credit.
So I can just make an LLC today and void
Yep.
using my credit.
My wife just did one. He created the LLC while they were on contract.
Okay. So they don't should be hesitant to
No, because they care more about that asset. They actually care the most about the income of that asset. That's really what they care about. Obviously, they care about the value because they're not going to give you 100% financing on the value of the asset. But
Definitely qualifying borrower though,
yeah,
right? Where Charlie's just
Yeah.
qualifying the asset, they're
Right.
qualifying both.
right. Yep, yep. And they're usually sold off into a. The loans are usually, most cases, the loans are brokered into insurance funds. State Farm, a lot of these big insurance companies have pools of mortgages, of DSCR mortgages, and they love that. They just love that because they're getting 7.75 on their money, 8% on an income producing asset. So for those guys, the insurance companies, they love these pools. All right. Okay. I don't want to cover too much on this. I'm getting through it pretty quick, so that's good. Traditional mortgages, you guys pretty much know what it is. I'm going to hop to the assumption section.
You said this is what you're doing tomorrow?
Actually, no. It happens to be a VA loan, but we're subject to the VA loan. We didn't go through this assumption process because it takes too long. So we're just gonna subject to it. All right. We all know what a conventional mortgage is? Yeah? Okay. In this environment, you are allowed to assume VA loans and FHA loans. But then your question is, I've never been in the military. How can I get a VA Veterans Administration loan? I've never been in the military. You can't, but you can assume one. Because there is no VA requirement to assume a VA loan. But what you've got to do, though, is you do have to go through a loan qualification process. You've got to get your credit pulled. You've got to do income verification. You're going to have to submit tax returns. And so usually it's a 45-day process. The lenders don't necessarily, the servicer doesn't necessarily have to approve it, but Department of VA has to approve it. Okay? There is going to be a 0.5% VA funding fee, though, for when you assume it. So you're going to have to pay the VA a funding fee. Now, when you do a VA loan, there's something called the buyer can only have so many VA loans, right? What's the max now? 1.2 million? 9?
So if you have no VA loans, there's no limit, right? If you're buying your first house, they changed the rule a couple of years ago.
Okay.
If you have one or more VA loans, then you're subject to the county loan limits. We happen to be in a very high income area, so the income limit around
960?
1.089.
Is that what it is now?
Yeah, so
1.089.
So if your two loans, the new one and the old one, equal it, then you have no down payment. Anything above that, it's 25% of the difference.
Why does that matter? It's important because if you're a non-VA, a non-veteran, and you're assuming the loan, and let's say you're assuming a $400,000 loan, that veteran who has that loan is still on the hook for the entitlement. So where he said 1 million and whatever,
89.
you subtract 1,089,000 from the 400, he only has $689,000 of entitlement. So if he's buying an $800,000 house, he can only use 689 because he's not on the hook liability-wise because the new person that assumed it is on the hook liability-wise, but his entitlement's still on the hook. Yeah? Yeah? Okay? That's that. All right, now we'll get to the I got to go back. Sorry,
What
guys.
about
What
the
FHA?
equity? I had this conversation frequently. So we're in this market where rates went through the roof and equity went through the roof, which I think the combination is probably pretty unique.
Right. So they're going to have to. So let's say the equity jacked up, right? And they're buying a VA home on the VA assumption to take care of the lower interest rate. They're going to have to come up with, they're going to have to come up with the rest of that in down payment. So it could be pretty expensive. But it might be worth it to a lot of people to come up with that bigger chunk of down payment to take advantage of the lower interest rate. Because that's why you're assuming the VA loan, because you're taking advantage of the interest rate, right? This is all an interest rate game. This doesn't mean a hill of beans if we're a year and a half previous to this. If the rates are still low, this doesn't really play. It doesn't really come into play. You're going to get your own loan at a lower interest rate, so it doesn't matter. And for you realtors, it's a good tool to put in your toolbox to even know it exists. The next thing is FHA. FHA is the same thing as the VA. You can assume FHA loans. Same thing, right? Why are we doing it? We're doing it because we want to take advantage of that lower interest rate loans. That's what we're trying to do, help you guys out with, okay? Anybody can do it. You're assuming the remaining payments of the loan. Again, the qualification process is 45 to 90 days. They're going to do the same thing, income verification, credit scores, tax returns. The FHA is going to approve you as if you were a normal buyer. You're assuming a loan. I said 90 days. I don't know if it's 90 days, but it's at least 45. I think it's probably longer than the VA, but I got 45 to 90. Okay, you guys got that? Okay. HELOCs. Any questions on anything? Good. It should be done in about 10 minutes. What's a HELOC? You guys know what that is? Home equity line of credit. I'll go through an example here in a second. Why are we even talking about this? We're talking about this because it's going to be very important in one of my last slides. We're using it for liquidity. We're investors. 3 things that we got to do as investors. What's the first thing? Who has an income statement? I know you do. Who's got a budget? Y'all keep track of your budget? That's the same thing as an income statement. Expenses, income, hopefully it's positive, residual income, hopefully going to your investments. Okay. Who keeps track of their balance sheet? Guys, you guys are investors. We got to be thinking like investors. Balance sheet. Assets minus liabilities is your net worth. Create an income statement, create a balance sheet. Take a look at it every day. Okay? Liquidity, we're going to talk about in a minute. And we're going to cover that. But you guys got to start, if you're going to be investors in this business, you got to start acting like investors. You got to start being investors, right? Everybody wants to fix and flip houses. Everybody wants to build a big rental portfolio. But you guys have got to start at the very bottom and start doing the right financial, get your house in order. I don't care if it's a negative net worth. I don't care if you're down $1,000 a month because your bills are too big. Just do it. Just do it and just get your habits the right way. Okay, HELOC. Basically, you have equity in your house. You got a first loan. You're attaching a credit checkbook to your house. It's in the form of your equity. It's debt equity. We are kings of investing our debt equity. That's how we built our businesses, was based on debt equity, based on HELOCs, based on liquidity. So we'll go over an example here in a second. Oh boy, sorry. Okay. Here's an example so that you guys are familiar with it. You might not own your houses, you might not have equity. Let's say, for example, I lived in a primary residence for 10 years. The new appraised value is $600,000. Okay, that's what my house is worth today. And let's say my first loan, I only owe $250 on it, right? I want to get a home equity line of credit. How much can I get? Okay. A lot of times now, they're offering only 75% of the value of your home. Sometimes, though, once the economy gets kicking, credit boxes change. I've seen credit unions go to 90% of your ARV minus the first trust. Right now, because we're not in a very good credit environment, banks' credit boxes are changing. They don't like second trusts. It's 75%. So I'm going to assume it's 75%. So what they do is they multiply 75% times the value of your house. In this case, it appraised at $600,000. Right, so whatever that number is, it's $450,000, right? Because 75% of 600 is 450. They're then going to take 450 minus your first trust amount of 250, and they're going to give you a $200,000 HELOC. Why is that important? Because now when we go into the liquidity calculation here, you now have a checkbook of $200,000 that you can spend. I don't mean spend it on vacations. That's what they did in 2005 and 2006. That's why we are where we were back then. You're going to want to use that for investing, okay? Make sure you be calculating about it. Make sure you're risk averse, right? Make sure it's a good deal. But keep that $200,000 in your back pocket 'cause you might need it on a rainy day. That's how they do HELOCs, okay? Advantages, interest rates, flexibility, interest-only payments, okay? Now, disadvantages, interest rates. I remember when I first got I got a bunch of HELOCs because my strategy was to buy a primary residence. I'd buy at a good price, right, a discount, build a little bit of equity over a couple of years. I would get a HELOC on my primary residence because banks will do that. I would then move out, change it into a rental, right, get a renter in there, but I still have my HELOC. I then would buy another house, pretty good price. That equity would build up a little bit. I would get another HELOC on that house. Now I have 2 checkbooks in my pocket, and I would do it again. Okay? Again. HELOCs, okay? That's how you're going to build it up. So, but right now, some of my HELOCs used to be at 3.5%, 4%. Now they're up around 9.25%. Because again, it's the same thing. It's based on their variable rates. But it's interest-only payment, which is good because we're not tapping into the principal. Interest only makes it a cheaper payment. However, disadvantages. During recessionary times, banks can term it out. If you've had your HELOC out there for 10 years, sometimes they'll term it out. It just depends. I've had a line termed out. I've had one line termed out, and I've had one line where I had $200,000 line because of the recessionary times back in 9, 10, 11. Values changed. My $200,000 HELOC went down to 120. They didn't term me out, but my liquidity dropped a little bit. From 200 to 120, that's like $80,000. Poof, that you can't use it to buy something, okay? Which brings me into cash. Why am I talking about this? It's very, very important. Cash doesn't necessarily have to be what we think it is. Cash, to us, is the ability to use all things, and I'll get into that in a minute, to buy a piece of real estate. Why is cash so important? Because let's say that same deal that we were talking about, the $500,000 deal in Dale City, somebody comes to you and says, hey, Zach, I'm selling you this house for $300,000. Here's the issue, Zach. You've got to close it in 2 days. This is before the hard money, but you don't want to get a hard money loan. You've got to be able to come up with $300,000 in 2 days to close it, and you can buy it. It's yours. So the question you got to be asking yourself is, can I come up with that $300,000? And the reason why he's going to sell it to Zach is because he knows Zach can come up with that money, and he needs to sell it for whatever reason. Foreclosure is 4 days from now. Okay, so it's very important that you keep track of it. It's the easiest form of financing because there's no complications, right? Okay. Why am I talking about this? You're going to see here in a minute. Actually, there you go. I was going to say, there's no way. Okay, we'll talk about that. Advantages, quick close, ability to win the deal. He didn't go to anybody else because he knew that Zach could close that house in 2 days. Zach's my go-to guy. Don't you think, when we're fixing and flipping houses, don't you think I've got people coming to me because I'm the go-to guy? Because they know what are the one things they care about. Can you close? Can you close in 2 days, 3 days? You're the go-to guy, right? So if you have that reputation of being the go-to guy, they're not going to go anywhere else. Okay? So ability to win the deal, that's important. Disadvantages, right? We talked about this earlier. It's not scalable, non-leveraged return, lost opportunity on other deals, and then very, very difficult for new investors, and we're going to talk about it in a second because I've got a story for you guys. Ed's heard this story plenty of times, so don't say you know the story yet. As we go across our investing career, when we're newbie investors, we have no money. We ain't got nothing, right? We're trying to become experienced investors. Hopefully we have a good job and hopefully we have good credit. Totally different issues. So get a good job, keep good credit. Okay. So one of the first things that I did when I was a new investor, because remember, I'm not a silver spooner, right? We didn't start with much money. I grew up in Dale City. My dad made $55,000 a year raising 5 kids. We had no money. Teddy knows. He knows Dale City back in those days. So we had no money. I was middle class. Probably these days, what they call it, lower middle class? I don't know. We were middle class. We were poor as hell. We didn't care. But we didn't have no money, right? So I didn't know anything about real estate. Didn't know anything about anything. But when I got out of college, I was lucky enough, fortunate enough that I have an engineering degree. I was a data warehouse guy. I was a data geek. So I had really good income, and I had really, really good credit. But I had no money. So what I did is I got all these gold accounts. Y'all remember the gold credit cards? The gold accounts? $20,000 limit here, $30,000 limit here, cash advance limits. Remember those? What I did is because I had a good paying job, good credit, I applied for as many gold accounts that I could. And I would literally have a little notebook like that notebook you got right there. On the back of my notebook, I kept track religiously every credit card that I had, gold card, MasterCard, Visa, how much my credit line was. 20,000 here, 30,000 there, 40,000 there. I calculated what's called a liquidity, and I'm going to explain that in a minute. I had $300,000 of gold card limits. 300,000. I had never tapped into them. Zero. One day, I tracked down a pre-foreclosure, Madrigal Drive, 14390 Madrigal Drive. I still own it to this day. Pre-foreclosure, guy had to close in 2 weeks because he was getting foreclosed on. I knocked on the door. House was worth $200,000. It was a one-car garage townhome in what's it called, Prince William Commons. Okay. House at the time was worth $200,000. It had been built 2 years prior. He was the first and only owner. I knock on the door. I forgot his name. I said, I noticed that your house is getting foreclosed in a couple weeks, pre-foreclosure. You know, I'm an all-cash buyer. I'd like to buy your house. Right? He answered the door. He looked at me. He goes, okay. I was like, uh-oh. Because man, this is 1998. 1998. I didn't know what the hell to do. So I started talking to him a little longer. Kind of looking in the house, trying to figure out the condition of the house, really not knowing what I was doing. I said, okay, what do you do? He told me, I'm a teacher. It's April time frame. You know, I'm just down on my luck. I'm moving back with my parents to Ohio in June when school's done. You know, I don't have any family or friends here. He was kind of a hermit type. But he said, yeah. So I said, all right. I kept talking to him and figuring out what the hell do I do next. I said, okay, I will be here tomorrow because I was a dummy, I'll be here tomorrow at 3:30 with a contract for you to sign to buy your house. And we had talked about price, and we agreed on $130,000 because he had only owed like 110 or 120, right? He was getting foreclosed on. So I was giving him the magic number, $10,000 more than what he owed. He was happier than hell because he didn't think he was going to get any money. So I showed up the next day, had him sign the contract for $130,000. But remember, the foreclosure sale's in 2 weeks. I don't have a pot to piss in, excuse my French. I don't have any money. I had Dan Berinsky at Esquire Settlements because I needed him to pull a title for me. I knew there was a first trust on it. He obviously owed some HOA liens because he didn't pay it. But then what I started doing, once he signed the contract, I said, Dan, you have got to pull title, and I've got to close this in a week. Mind you, I have never done this before. I started showing up to the bank every day for 4 days, drawing down my cash advances until I had $135,000. So I loaded my account up with $135,000 3 days before I had to close. Why did I do that? Because I needed to make sure it was cash. I'm getting charged 3%, 3%, 3%, 3%, 3%, 3%, right? I'm a dummy. Oh, you think I'm a dummy? Nah, maybe. So that 135, right, times 3%, that's a lot of money to me, right? So 3 days goes by. I show up with a cashier check for $135,000. We close on the house. Okay? Not bad, right? It's worth $200,000 fixed up, but it was pretty good shape. Fortunately for me, I was going through a divorce, and so I needed a place to live anyway. But I had to give him a couple months free rent because to solve his problem, he was moving to Ohio when school was up. But remember, what do I look like at this point, right? I owe $135,000 in credit card debt. But I own a house that's worth $200,000 lien-free. $200,000. And guess what? Remember, I told you I had a good income-paying job, good credit score. I'm bankable. So what do you think the bank said when I went to apply for a mortgage a couple months later? They said, hell yeah, we're giving you one because the house is worth $200,000. I've got a 750 credit score. I've got high income. They gave me a mortgage for $140,000. Paid back all my credit cards, put a couple $1,000s in my pocket, had a very low payment. Okay? I had nothing. That's how I got started.
I kind of like, Charlie, one thing I was telling you last time we talked about this story, it's different from tonight's discussion, is you sort of started where you ended up. Because, you know, you talk about it in the context of cash. The way I view that is you became your own hard money lender.
Right.
And were forced the bank essentially to become a hard money lender because
Right.
just like at 12 and 3,
Right.
you were probably paying 20 and 3.
That's right.
You paid that three points essentially on the credit cards, and because you were able to refinance quickly, you didn't
Yeah.
care. Was it
Right.
12? Was it 20?
Right.
And you had enough cash to float that.
Right.
during the process.
And it was 18%.
There you go, 18.
But I had it out there for 2 months. Holding costs weren't that big of a deal. This is before the days of hard money.
Well, that's the thing about the hard money too, is
Yeah.
that 3%, it's a huge number. Like I've never taken a cash advance on a credit card because of that. However, when you look at the overall deal, the 3% is irrelevant.
Right.
It doesn't matter.
Right.
That
So,
you could get the deal.
right. So why are we talking about this? We're not talking about this so I could share a story and brag. We're not doing that. We're talking about this because as your investing career goes from, and it's not age-based, it's investing career-based. Your maturity from an investment standpoint, and nothing to do with your age. You're gonna have credit cards. You're gonna have personal lines of credit. You're gonna get HELOCs because as we own our first properties and they go up in value, we'll be able to get HELOCs. And then you're gonna have more and more cash investments, right? So as we mature as investors, this is the path that you guys are gonna follow. And it doesn't matter where you are in this path, because a lot of us might be here, maybe some of us are here, but it doesn't matter. Even if you have zero, if you have a couple thousand, at least do some things to get you over the hump. And I'm going to talk about something called liquidity here in a second. Oh, and here we are. Remember we talked about as investors, we talked about income statements, your budget. We talked about balance sheets, which you guys better start doing your homework. The third thing that you need to do as investors is calculate your liquidity. Liquidity is the measure of monies that I can get my hands on within a certain period of time to buy, and I'm just going to caveat this, to buy real estate. I didn't say go buy that risky stock. I didn't say go margin it. I said real estate. Okay? Like I said, I sold that house to Zach in 2 days because I knew Zach could come up with $300,000 and close that deal in 2 days. Doesn't necessarily have to mean it's cash. So as an investor, the third thing that you need to do is you need to calculate your liquidity. You can calculate it monthly, quarterly, annually. I don't calculate my liquidity anymore because of where we are. I calculate our corporate liquidity. You're damn right. Clear Sky Financial, we're calculating our liquidity every day because we got to fund deals every day. We got money coming in, money coming out, and we got to be able to fund deals, and we got to be able to commit to deals, and we need to know our liquidity on at least a weekly, daily basis. But from a personal standpoint, I don't do it anymore because I don't have to. You guys, if you don't have many assets, should calculate it. I would do it every quarter, maybe every month. If you got good paying jobs and you want to increase your liquidity, then do it. And I'm going to show you how to do it here in a second. Here's your calculations. Very simple, guys. Liquidity is cash on hand. We all got some kind of cash on hand. Plus your HELOCs. Maybe we're not mature enough to have HELOCs. Not a big deal. Plus your credit card availability. Remember, I might have had $5,000 to my name, but I had $300,000 in gold cards. I was fortunate that I had a good paying job and good credit, but I had that sitting out there for a rainy day. I didn't know when it was going to rain. One day it rained. I was lucky. Not lucky, but I was ready. Plus your other bank relationships, unsecured, right? Go in that Wells Fargo, get a personal line of credit. Don't spend it. Don't spend it. It's not a vacation money. Borrowing power against your brokerage accounts. So if you guys got brokerage accounts, stocks and bonds out there, cash accounts, maybe you get borrowing ability against it. Don't use it for margin. That's a little risky. Just have it out there for a rainy day. I got a couple Schwab accounts, Goldman Sachs. I've got 2 big lines, Goldman Sachs with my personal. I've got a bunch of HELOCs, but they all have zero balances on it. But for a rainy day, like I almost funded that deal on Q Street. It was a $1.5 million deal. The guy was buying it for $2 million. Asset was worth $3.5 million. $2 million. He's putting $500,000 down. We were gonna do a $1.5 million loan on it. Remember I said as the bigger loans, I got to bounce it off Sam and Ed. Well, they didn't like the underlying borrower. They hated the borrower. He had bad character. So we turned it down. I was going to do it myself, but I decided not to, just because it would have been a headache and I didn't want to leave the reservation really. But I was ready to go because I had all this stuff out there, because I calculated I knew what my liquidity kind of was. Plus, it's the money raising ability from your friends. So you guys have got to be investors and you've got to keep track of your liquidity. We all start from zero, or at least I did, and most of us in this room probably have. So just remember, if you're going to be an investor, you got to think like an investor. Okay? Pre-recession actions, we think we might be going into a recession. When I did this presentation, it was for regularriches.com. This presentation is part of a 7-module product that they are selling on regularriches.com. They're selling it for $12.95. I'm in there on 2 modules. This one, plus how to find distressed assets. And so I had to do pre-recession actions because we might run into one. What's the first one, guys? Understand your liquidity. Maintain good credit. I don't care what you do. That credit's got to be top-notch so you can get the lowest rates. Increase your borrowing power every day. Doesn't have to be credit cards. Figure it out. Figure it out how you can get these lines of credit with $0 on it. Figure it out. Increase your cash reserves. That's why you're keeping your balance sheet, your income statement. Hopefully all you guys have residual income. It's the positive income minus expenses. Sock that away. That's your cash reserves building up. Have multiple exit strategies on your properties. If you're buying a fix and flip, economy changes, be ready to rent it out. And then loan products are changing during a recession. I think that might be it. Yeah, that's it. All right. So, any questions? That's who I am. You guys can feel free to Google me. I'm just kidding. But I hope you enjoyed it. I hope you learned something.